Hello student, you are welcome to AEA 308 class, the principle of farm management. The topic of our discussion today is on the common concepts and tools in farm management. I am Helen, BE, your course facilitator. Stay put and listen. Thank you. There is no further increase in marginal products or the quantity unit of fertilizer applied at that point will be the point of diminishing returns. There is no further increase. That is the point of diminishing returns. You can see here, there is no further increase. Nothing is coming up again. So it's a point of diminishing return. So if you continue adding, it will decline up to the negative level. So at this point, when it reached the point of 180, then there is no much increase here, no further here, 0 here, 180 here, there is no further increase, it's 0. And then if you continue, it gives you negative. So the farmer, if you continue to add and add, if you end up operating at a loss at this point, as the point in returns. So having looked at that, let us also look at the substitution, the principle of substitution. The principle of substitution refers to the amount by which product A changes in quantity when product B is increased by 1 unit while the inputs remain constant. Farm managers is interested in the optimum combination of products that will enable him maximize his net returns or output. The concept of marginal rate of substitution is central to choosing the optimum production combinations. That is, you combining two products with another. So, and also with the introduction of technology, with the introduction of new technologies in agriculture, farmers are exposed to different methods of combination of different methods or methods of combination of farming. The major objectives behind the principle of substitution is either to maximize output or minimize the cost of production. So for this, the farm manager needs to decide upon best possible resources combination to achieve maximum output at a given cost or to minimize the cost of producing a given output. That is what the farm managers can do. So let us look at these examples now. There are examples here we can look at. These are the examples that we need to look at. Here, examples of resources to achieve maximum output with inputs used remaining constant. This includes production of maize and poultry in a given plot of land, production of grains and fruits in a fruit crops in 1 hectare of land, production of farm and non-farm products using the same laborers. You can see with this combination now, you'll be able to, the farmer will make maximum output. Above, the example will also show how to produce minimum output where alternative products can also be used for the same resources, subject to certain constraints. We look at the principle of substitution. Here is also used to find out the least cost combination needed to produce a given product. The least cost combination, taking for example, commercial and manual weeding in the production of a given quantity of yam. That is substituting tractor for hand tools in the production of a given quantity of maize. hay and maize combination for a constant output of milk, and combination of grains and hay for a given lightweight grains. So these are the least possible cost, least combination of resources that is needed to produce a given output. As these are the typical examples. There are other combinations. Then let's look at the objective or the opportunity cost. Opportunity cost is the alternative forgone in either the consumption or production of a particular goods. So the concept of opportunity cost is in economics is the economics way of expressing the cost of present benefit in terms of foregone alternative. The opportunity cost of a farm management decision is the amount of money which is given up by choosing one alternative rather than the other. A choice means you have one thing or the other to do. It implies sacrificing one thing in favor of the other. Taking for example, you want to cultivate, you have two items in mind to cultivate. Let's take for example maize and rice. So which one do you prefer? Okay, you may prefer rice, but that means you have to forego the cultivation of maize for rice. So the cost of anything is not the money spent on it. It is the alternative which was most nearly chosen instead. In farm management, for farmer to obtain maximum return, the money that is given up by choosing one alternative rather than another must be less than the chosen enterprise. Yes, so we are going to look at the example. Taking for example here, if the same amount of resources are available for production of 1 acre of either maize or sorghum, and expected revenue from maize is 1,000, while that of sorghum is 800 naira. So if sorghum is chosen instead of maize, that means we forego 1,000 in order to obtain 800. Here the opportunity cost is positive and should be avoided if there is no serious case against the production of maize. So on the other hand, the opportunity cost of cultivating maize rather than sorghum is negative. That is, we forego 800 naira to obtain 1,000, which is a good decision. That is it. Negative of opportunity is negative because we forego 800 naira. But if we forego 1,000 and then produce and go for 800 naira, that's negative. So we forego one and then 800 naira. We forego 800 naira to obtain 1,000 naira, which is a good decision. Diversification. Diversification and specialization. So specialization involves the production of one type of product. Farmer may specialize in poultry production only. He may also decide to engage in palm production only. But by specialization, the farmer may likely be more efficient in his operation and technique of the business. That is, when you are specialized, you will become very, very efficient in your business. But then, there is a problem there too, because once you are specialized on a particular product, in case of uncertainty, that means you will lose everything just because you specialize on a particular product, because you will not be able to do the other. But taking for example here, the specialization is always accompanied with risks, because once the business fails, there is no other way of producing another product. because you specialize on one aspect, enterprise. So the failure can occur as a result of pests and diseases outbreak, market situation, and other factors. So you will have nothing to fall back for. But diversification, on the other hand, involves combination of two or more products or enterprises in one operation. For instance, a farmer can engage in production of maize, sorghum, and poultry at the same time. He may also engage in production of grains and oil palm plantation and others, etc. So the rule guiding the operation of diversification is that the two enterprises must be correlated, must not be correlated in income. That means they will not attract the same resources for production. If two farm enterprises require the same resources and are likely to be affected by some condition, a reduction in the gross margin of one output will imply a similar reduction in the gross margin of the other enterprises. So this is a situation of positive correlation. So, but it is therefore beneficiary to diversify into enterprises which have negative correlation. They don't they don't require the same resources for production. Negative correlation of gross margin. So this is necessary to reduce the effect of risk and uncertainty connected with farming. So diversification allows flexibility in the use of resources and lowest income variability or lower income variability. Let us also look at farm costs. So when we talked about farm costs or production costs, there are payments or expenses made either directly or indirectly to obtain inputs utilized in production. Cost is a sacrifice that must be made for the purpose of doing or acquiring something. So the total cost can be calculated as follows. Total cost CC is equal to fixed cost FC plus variable cost. That is total cost. That is the fixed cost plus variable cost BC. Then average cost, that's a mistake, supposed to be a number of input units. Okay, sorry. Average cost is a total cost of producing an output divided by a number of output units. Is correct? Number of output units. That is total cost over total product. How much is the total cost divided by the total products received or obtained? Then where TC is the total cost and Q is the unit of output produced. Then average cost is the sum of average fixed cost and average variable cost. That is, you sum them together. We have seen that already in total cost. Look at it. The average cost is equal to average fixed cost plus average variable cost. Is equal to AC is equal to AFC plus ABC. Average fixed cost is obtained by dividing total fixed cost by the unit of output associated with it, with the fixed cost. Average fixed cost is equal to total fixed cost all over total product. TFC all over Q, where TFC is equal to total fixed cost and Q is equal to units of output. For example, with an output of 10 units and a total of fixed cost of 3,000 naira or 300 naira, average fixed cost is equal to total fixed cost all over total product. That is 300 naira divided by 100, giving us 3 naira. Then similarly, average variable cost is obtained by dividing the total variable cost by the units of output produced. Taking for example, if a farmer produces an output of 1 160 tons using the total variable cost of 480 naira. Then calculate the variable cost. The answer here is average variable cost is equal to total variable cost all over the units of output is equal to 480 naira divided by 160 tons, giving us 3 naira. Valuation and depreciation of farm assets. Farm valuation, as the name implies, involves setting values or attaching price on properties. When applied to the farm business, valuation means setting prices on farm assets, such assets may include machines, buildings, livestock, growing crops at the end of accounting period, farm output in store, and unused farm input kept in the store. All this has to be valued and attract cash price to them. Valuation of farm asset is necessary to be able to enable the farmer calculate his net worth at the end of the accounting period or at the end of any given period. Let us look at the methods of valuation. There are 4 different methods of valuation here. This includes valuation at cost, that's computing with the actual cost of purchasing the farm assets. Valuation at cost less reparation charges, depreciation charges. This method used mainly for farm machineries and equipment. Valuation at market price, computing with current market price of the farm assets. And also valuation at cost or market price, whichever is lower there. Let us also look at depreciation. Definition. What is depreciation? Depreciation is the reduction in value of an output or asset through wear and tear. You know, when you buy a new machine, as time goes on, that machine will depreciate. That machine will reduce in values as a result of wear and tear. It will worn out. While depreciation charges is the amount of money or an allowance is set aside annually on farm assets on the ground that the use of farm capital asset is one of the costs of earning revenue of the business. That means if you are a very good farm manager, you must every year set aside a certain percentage as depreciation or out of your money, the money you gain. So you have to be able to realize you set it aside. Why are you doing this? So that you can use this either to repair or to replace the machine instead of going to borrow money to buy the machine, a new machine. Already before, while you are still using, you have already set money aside for that. And this depreciation charges will help you to guide against collecting, maybe being paid or paying heavy tax, because if you don't do that, that means your net profit will be so high. As a result, the tax that you are going to pay as a result of your revenue will be higher than expected. So the best thing is to calculate on a yearly basis your depreciation charges and keep that one aside. That one should be a no-go area. That money will be used to replace a new machine or used to repair. So the advantages of depreciation is enable farmers to replace farm machines and equipment with ease without resulting into borrowing, like what I was saying. Since depreciation is regarded as cost and is always made before calculation of profits, so it will seriously reduce the amount of tax paid, which I have explained already. Methods of estimating depreciation charges. We have three methods here: the straight line method, declining balance method, and the sum of the years digit method. So let's look at them one step by step. The first step here is the first thing you need to do: state the formula. In calculation, the formula must be there. Annual depreciation is equal to cost of asset minus salvage value or expected life of that asset. The next step is find the value of items in formula. Cost of assets is equal to 10,000. This must be listed down when you are calculating the assets. When you are calculating it. So the cost of asset here is equal to 10,000 naira. That is how much this asset was bought. The salvage value is 2,000 naira. Then the expected life of that asset is 10 years. So now the next thing is now you apply the formula. Annual depreciation is equal to cost of asset minus the salvage value. You have this 10,000 minus, the salvage value divided by 10 years. That is the number of years, the expected life of that asset. So this gives us 800. You have already subtracted 10,000 from 2,000 from 10,000. You have 800 here. 800 over 10 is equal to, 8,000 over 10 divided by 10 gives us 800. So this is the annual depreciation. So this is what is expected of you to, in every year you calculate and drop. Okay. Then whatever should be set aside every year for 10 years is this. That's the annual depreciation of that asset. Every year, at the end of every year, you keep 800 naira. You discover that you will be able to realize that the money you can use to replace the new machineries after that 10 years. But if you don't do that, you end up borrowing to pay or replace. So the advantages of this method is that the major advantages of this method is that it is easy and straightforward to calculate. It is easy and straightforward to calculate. This method is not very useful for assets like machines and equipment in which the rate of turnover decreases with age. Decline balance method, 900 naira. You know the formula, how it goes. 656.1 kobo. So that is decline balance. So let us look at, then for the salvage value, you are asked to also calculate the salvage value. So the salvage value is whatever is left at the end of its useful life. So whatever is left at the end of the useful life here is 6,000 is what? 6,500 after 5 years. 6,561 naira minus 656.1 naira. When you subtract it, you have this 5,904 naira 0.1. This is the salvage value of what is left. The salvage value is the last, what is left minus the last year expenses. Then the sum of the years digit method, we have this method is just like the decline balance method, distributing the depreciation. Like the decline balance method distributes the depreciation expenses more heavily in the early years of use and more lightly in the later years. However, it has some advantage over the decline balance method. It avoids an undisturbed distributed balance at the end of the useful life, and the depreciates the investment to the scrap value assigned. So looking at this now, let's look at the sum of the year method, which involves working out of a fraction with the denominator and numerator, which is applied to the value at the beginning of each year. So finding the denominator, we have, for instance, if the lifespan of an asset is expected to be 5 years, then the denominator will be addition of the number of years, that is 1 plus 2 plus 3 plus 4 plus 5, which gives you 15. In this case, the denominator is 15. Let's see how we'll be able to get the nominator. The nominator of the fraction is the number of years remaining at the end of the accounting period. From the above example in year 1, the numerator is 5 and the denominator is also 15. In year 2, the numerator is 4 because you subtract is 4 and the denominator is 15. In year 3, the denominator is 3 and the denominator is still 15 because it varies. That one is remaining, reducing. Then year 4, we have denominator as 1 and the numerator 15. Denominator is 15. In year 5, the denominator has 1. Year 4 has 2 denominator and the denominator is 15. Year 5, the denominator has 1 and the denominator remains 15 throughout the periods. So let's look at the working example here. If an asset costs 17,000 naira and can be sold off in the next 5 years for 2,000, calculate the annual depreciation using some of the year digit method. So let's look at it. Getting the denominator, we add it, sum them up together, year 1, 2, 3, 4, 5, which will give us 15. Then step 2, you get the fraction of each of the year. Now year 5 is equal to 5 over 15. Then year 2 is 4 over 15. Year 3 is 3 over 15. Year 4 is 2 over 15, while year 5 is 1 over 15. So we have been 17,000, which gives us 17,000 as the cost of the purchase of that equipment. Appreciation. We have seen the depreciation. Let's look at appreciation. Appreciation is opposite of depreciation. Appreciation occurs as a result of increase in the value of an asset. Appreciation may occur through rising prices as a result of inflation, scarcity of the assets, or increase in earning power. Yes, any of these can cause appreciation. If after adding all the annual depreciation charges to the salvage value, then the total value of the asset is more than the original cost, then we have a case of appreciation of an asset. But if the addition of all the annual depreciation charges with the salvage value is equal to the original value or cost, then appreciation is 0. There is no appreciation. Also, the replacement of cost of an asset may be very much greater than its original cost. This problem is dealt with by revaluing assets at the interval or even annually using special capital cost indices and adjusting depreciation charges accordingly. This is called replacement minus cost depreciation. So in conclusion, that we have been able to learn about the economic principle that farmer can be applied in farm management to obtain maximum outputs. We have also been able to discuss on the different types of costs associated with farm business. We have learned the meaning of valuation and various methods used in valuation. We have also learned about appreciation as well as depreciation. Summary: there's the lessons we have learned that the concepts of diminishing returns determine the economic level of all production practices. The opportunity cost of a farm management decision is the amount of money which is given up by choosing one alternative rather than the other. Specialization involves the practice of one enterprise, while diversification involves the practice of two or more enterprises. Then diversification can also guide against failure if the enterprise with negative correlation is in gross margin are combined. We have learned about the various farm costs. We have also learned about valuation involves attaching price to farm assets. We have learned about depreciation, which is regarded as cost, and therefore reduce the tax payment for the farmers, which is very, very important. Please, we should learn to always calculate our depreciation charges and put it as a cost. And this will help to reduce our tax payments. Then appreciation occurs if the sum of the depreciation value and salvage value is more than the original cost. So these are points you should note. Before we close, give you this assignment. This is the assignment. The assignment is: a tractor was purchased by a farmer in 1998 for 6 million naira. In 2007, the tractor was sold off for 150,000 naira. When it was no longer economical to maintain, calculate the tractors. Salvage, that is tractors, number 1, salvage value. The tractor's total depreciation, number 2. Number 3, annual depreciation. Number 4, appreciation. We'll discuss this in our next facilitation.